Hello and welcome back to the Live for Today, Plan for Tomorrow podcast. I'm your host, Gabe Bodner with the Bodner team of One Trust Home Loans. We've got a great topic for you today, and that is comparing a HELOC, also known as a home equity line of credit, to a reverse mortgage line of credit. I'm going to give you 7 reasons why you might want to consider looking at a reverse mortgage line of credit instead of a HELOC. Let's dive in. All right. Number one, first most important reason that you might want to consider a reverse mortgage line of credit is because of the payment requirement. So you see, with a HELOC, you are required to make a payment every single month. Now, typically with a HELOC, you are allowed to make interest-only payments for the first 10 years. However, after the first 10 years, you will roll into what's called the repayment period. And the repayment period is typically either 15 or 20 years. And during that repayment period, you are required to pay the principal and interest amortized over either, again, 15 or 20 years. So what that means is, as you use the HELOC and as you take money out, 10 years later, you're going to be looking at a significantly higher monthly payment because once again, the lender is going to take your balance at the end of 10 years and re-amortize that payment over the next 20 years with principal and interest. So this becomes a very, very dangerous situation for older clients. Let's think about this. If you are 62 years old and married when you get a HELOC, 10 years later, you're 72 years old, and now you're forced into a higher monthly payment, once again, of principal and interest, amortized over a short period of time, again, 15 or 20 years. That can once again be very dangerous if you're 72 or think about 75 years old, where life happens, right? Whether it's a medical situation, whether it's a home repair, and now you're once again locked into this payment. Compared to the reverse mortgage line of credit, there are no monthly payments required. Again, there are no monthly payments required. You are always allowed to make a payment if you want on a reverse mortgage, and you're simply not required. So it gives you a lot more flexibility when it comes to the payments with a reverse mortgage line of credit compared to a HELOC. All right, so that's number one. Number two, the line of credit with a HELOC is a fixed amount. It's a fixed credit limit. Let's just say, for example, you get qualified for a $100,000 credit limit. And again, during that 10-year period that you're able to draw on the line of credit, that credit limit will not and cannot increase. So as your home value goes up or as you take money out of your line of credit, you cannot increase that line of credit without having to refinance, requalify, get a new appraisal, pay additional fees, and so forth. Okay. So you've got this fixed credit limit. Now, with the reverse mortgage line of credit, the credit limit grows or increases over time. So let's take the FHA product first and foremost. That's also known as a HECM or HECM, home equity conversion mortgage. That HECM line of credit grows at the interest rate plus 0.5%. So if the interest rate, for example, is 6.25%, you will see a growth rate on your available funds at 6.75%. Again, if interest rates are 6.25, it takes the 6.25 plus 0.5%, which is the annual mortgage insurance premium cost. Add the two together, that's 6.75% again in that example, and your unused portion or your available portion of the line of credit is growing now at 6.75% annually. That's a fascinating way to look at, once again, your unused portion. If you qualify for a $100,000 line of credit and you didn't use the money, that means effectively in roughly 11 years, you will have $200,000 available to use in the future. Once again, compared to a HELOC, where your credit limit not only increases, but in 10 years, the available funds actually go away. Okay. And that's point number three. Point number three is the accessibility of the line of credit. You see, with a HELOC, the available funds in your line of credit can actually be decreased or taken away from you without any warning. And lenders actually did this over and over again. When you go back to the 2008 mortgage banking crisis, many lenders and banks and credit unions were freezing home equity lines of credit and removing the available funds that homeowners had in their HELOCs due to market conditions. And again, that can be done at any point in time. So a HELOC and the accessibility of the funds in the HELOC are not guaranteed. They can be decreased or taken away at any time. Now let's look at the reverse mortgage line of credit. The available funds are guaranteed to be available as long as the borrower lives in the home and complies with the loan terms, which are effectively continuing to pay property taxes, homeowners insurance, HOA dues if there are any, and maintaining the home, which are basically the same exact requirements of any loan other than the occupancy piece, because the reverse mortgage does require the borrower to occupy the home. But once again, as long as the borrower remains in the home and complies with the loan terms, the funds cannot be taken away. And these funds are good for life, which is the next point, point number 4. Let's talk about the due date or maturity date. Because with a home equity line of credit, again, as we talked about initially, a HELOC typically becomes due at the end of either 10 or 20 years after the initial draw period is over. Then you roll into the repayment period. So if you have a 10-year draw period and a 10-year repayment period, you could have a 20-year term. If you have a 10-year draw period and a 20-year repayment period, you could have a 30-year term. But all in all, this does have a termination date or a due date where the loan balance is due and payable. Okay. However, with a reverse mortgage line of credit, the loan balance is actually not due until the last borrower or eligible non-borrowing spouse permanently leaves the home. So let's break that down once again. If the borrower continues to live in the home, pay taxes and insurance, and maintain the home, they never, ever have to pay the balance off. Okay, until they either choose to sell the home, then they'd have to pay the balance off. Or if they permanently leave the home, like if they went to an assisted living facility or memory care facility, then the loan would become due and payable. Or once again, after the last borrower passes away, then the loan becomes due and payable. Otherwise, the maturity date on the loan documents is the youngest borrower's 150th birthday. That's right, 150th birthday. That is when this loan technically says it is due and payable, which of course nobody's ever lived to be 150 years old, let alone 125 years old. So this loan's due date truly is when the last borrower permanently leaves the home. All right. So let's move on. Bullet point number 5, prepayment penalties. A HELOC may have a prepayment penalty. Okay. In some cases, you will be penalized if you pay off or close a HELOC prematurely. However, with a reverse mortgage line of credit, there are no prepayment penalties. You can always make a payment. You can always pay off the reverse mortgage balance at any time, once again, with no penalty whatsoever. Okay. Number 6, a HELOC is not insured by the federal government. It's not. It is what's called a recourse mortgage. Okay. If you end up owing more on the home than the home is worth, you are financially responsible for that balance. However, with a reverse mortgage, these loans, specifically the HECM, again, HECM, home equity conversion mortgage, it is insured by the Federal Housing Administration, or FHA, which means it's a non-recourse mortgage. Okay, and that non-recourse feature, once again, means that you cannot be financially responsible for any amount of money that is potentially owed above and beyond the value of the home. The maximum that can be owed is the value of the home. That's the only recourse, is the home. There's no other recourse above and beyond that for either the homeowner or the heirs. Lastly, annual fees. Okay, HELOCs typically do have annual fees. It is very common that banks and credit unions will waive the annual fee for the first year, but it's very common that a HELOC has an annual fee of anywhere from $100 to $150, upwards of $500 per year. Okay, versus the HECM does not have any annual fees. Okay. Of course, there's interest charged and there's mortgage insurance charged on the HECM product, but there are no actual annual fees associated with the HECM or the HECM line of credit. Now, I went through that pretty quickly, but that hopefully gives you a really good understanding of the pros and the cons and the differences between a traditional HELOC and a reverse mortgage line of credit. Once again, I would argue that if you are age 62 or over and you have a lot of equity in your home and you are considering getting a HELOC to tap into some of your equity, you should consider a reverse mortgage line of credit and do a side-by-side comparison and see the pros and cons of each option. Because as I said earlier, the required payment on a HELOC can become dangerous as we age and as life happens. Sometimes becoming financially strapped can become, once again, a dangerous situation when you're in a HELOC with a required payment that rolls into a fully amortized principal and interest payment after 10 years. I hope this was helpful. If you have any questions about a reverse mortgage or the HECM line of credit, we'd love to assist you. We'd love to answer your questions in any way that we can. You can give our team a call at any time at 720-600-4870. Thank you so much for listening, and we look forward to assisting you and helping you live for today and plan for tomorrow.